Welcome to the Furlough Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both properties and residences so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessi.
Hey, I just heard something interesting. So I have this friend who's, for New Year's, for 2025, she set this goal to go smartphone free.
Okay.
And
wow.
So it's like they got a landline for their house so people can communicate like to the family. And she's getting like a dumb phone.
Oh,
whatever. No internet.
It's a pretty hot trend right now.
No camera. No, I guess it texts and does phone calls.
Okay.
But she's kind of like, the texts may or may not come through, so just call me. Which is like, man, that is not how I typically function.
Yeah, it's kind of weird. Those old school phones are not designed for group texting at all.
Right.
I've been on ones with those, and what happens is like they end up sending just a single text.
Right. It's super confusing.
Super janky, which is probably the number one reason why people don't. Now, so the big trend actually now is that they've created smartphones that act like dumb phones so that you still get some of the niceties. Like, so if you want a camera, okay, you have one. If you want a text, you can do it. If you want email, you can do it. If you want a phone call, you can do it.
Yeah.
But you can't install any of the other stuff. Okay. And oftentimes they're black and white. They might have like e-ink type of screens.
Sure.
That kind of stuff.
Which I totally get. There's different schools of thought on all of it. And, she maybe is on the more extreme school of thought of I want everything gone. I just want the very, very, very basics.
Did she say why she's doing this?
I haven't talked with her yet, but I would like to follow up and kind of ask what her motivation is. I think a lot of it is, we just create these unhealthy habits with our smartphones of reliance for information, for photos, for, just information that you can look up at any moment.
So you could say she's noticed some red flags in her life as a result of her smartphone usage.
I think so.
And after the fact, she's now saying, hey, you know what? This phone was a bad investment for me. Well, and so I'm switching to a different, come on, help me out here.
I see what you're doing. I would say, yes, there were some red flags. So she's taking a pause. Okay. It's not a forever change, but it's but
it was a bad investment.
This is interesting. At
that time.
Sure.
And so she's trying out a different investment to see if she can get a better return on her life and her time.
Sure. Yeah.
Okay.
Yeah. There were some challenges, some interesting things that made her reevaluate. I would say that.
Okay. Yeah. All right. This feels like more information than we need. So that's interesting. And what I want to talk about are red flags when it comes to real estate investing. Because like a smartphone, oftentimes something can seem flashy and awesome at the beginning, but then as you get further down it, you go, ooh, there's
maybe
this,
not so good.
Yeah, this may not be all that it's cracked up to be.
Yeah.
And so I want to talk about that. And I've got a bunch of different categories, a bunch of different flags that are red, that if you see these, it's not necessarily like, hey, total stop, we're not moving forward, but it might be more of a like, okay, I need to investigate a little bit more.
Flag on the play.
Yeah. So just out of curiosity, if you had what would be red flags to you? Let's just start out with that. Let's see if you got any off the top of your head.
It would. Okay. Is this like before I know anything about the property? Like before I investigate or get numbers?
So someone like myself, a sponsor, has come to you and said, "Hey, I've got an investment. Okay. Here's all the information."
And I'm going through this information.
Do I invest or not?
Yeah. It would be a red flag to me.
It's all different phases, but
I think if after like the repairs and the fix-ups and everything, it didn't make any money, I'd be like, is this really a good deal? Like, I don't think this is a good deal.
For a long-term hold, it's to have it not have any positive cash flow after.
Right. It's kind of like
after the value add has been added.
Yeah.
Okay. Fair enough.
That would be a red flag to me. Another red flag.
Or same if it's a flip, it's just the value afterwards. You're like,
it'd be like,
not making any money off of this. Okay.
Like
great.
why? Yeah. Why?
Yeah.
Would
fair
we?
enough.
That would be one. Another one might be if information was missing. Oh. If I was like, okay, I see partial information here, but I don't have you didn't give me the past rent rolls or like what the property could be worth or like why are there gaps here? I might be like, why aren't you telling me everything?
Yeah. Okay. Do you think there's any that are a bigger deal to you than not? Like, what if they don't have like a market? Like, Here's what the market's about. And maybe it depends on the type of investment. You're thinking more like longer term hold.
Right. I'm thinking like longer term. Yeah. I mean,
or like if they don't have okay, all right, how about this? They just have a construction budget line item.
Right.
But they don't actually specify what that is.
Right.
How much of a red flag is that to you?
It's maybe not a red flag, but it is a
How did you come to that number?
Yeah. How does this break down a little bit further?
All right. Mm-hmm. Gotcha. What about the opposite direction? Like you see all the numbers and they look too good to be true.
Oh, yeah. That could
like if I was like, you're gonna make 1,000%.
Yeah, okay.
Over 100%. We're gonna double your money in less than a year.
Yeah, I might be like, tell me more. How does that actually work out? And is that the case for every investor, or you give me a sweet deal, or
sweet little deal?
There's something there that's like too good to be true. That's all right. Yeah, that might pique my interest.
That's my very first one. Is just what I would call unrealistic ROI expectations.
Yeah.
As a general rule, like if you're a lender, you should see interest rates. It's going to be like that 12% range. Mm-hmm. If you are an equity person, it's also going to be somewhere in that 12 to maybe 15% range. It might go as high as 20, but it's more like special scenarios if this stuff works out. Okay. Yay. If you see things that are a lot higher than that, or in very short time frames, you might be like, I don't know.
So other than listening to podcasts like these, or reading books or whatever, how would I know that it's outside the range?
That's a great question. I think part of it has to do with you look at a lot of deals. I've got a due diligence check sheet or a checklist that you can download. And in there I talk about, hey, here's what a normal range is.
All right.
I think too, I think people, you just have a sense of it.
Yeah.
You know, if I told you it's got a 50% ROI.
Yeah, I'd be like, that seems high.
Right. So there you go. So that's kind of, if it feels high, you just got to ask a lot of questions. What's driving that? Yeah. And similarly related to that is like, there's just no stress testing, right? It's like, it's one scenario. This is it. Like, here we go. Yeah. They didn't say like, well, what if this takes longer? What if expenses are higher? What if rents don't grow as much?
Yeah, it would be easier to believe if they gave me some range.
Yeah.
You know, a range of ideas based on different factors that might affect the return.
Yeah. There's another one that's kind of an interesting one. This one's really hard to suss out, but it's leverage risk. So in theory, as long as the interest rate on a loan is lower than, say, the cap rate for a longer term hold, you should lever as much as you absolutely can, because for each more incremental loan you get, the better it's a better lever. Right now, Oregon's a little opposite, where mortgage interest rates are higher than cap rates.
So give me a real number example of that.
Okay. I'm just going to make this up, but let's say you got a property you're buying. If you bought it for all cash, your return on investment would be like 10%. But if you get a loan because of whatever, you got to do a smaller down payment. And let's say you get a loan for 50% of it. Now, all of a sudden, again, I'm making this up. Your ROI could be 15%. But if I get a loan at 75%, now my ROI is actually 20%.
Okay.
And if I had a loan at 100%, my ROI would be infinite, because in theory I didn't put any money down.
You didn't put anything down. Okay.
Right. So that's kind of
interesting.
It is kind of exponential in that regards.
Sure.
And so there's things that people can do where they go, oh my gosh, we're going to get you a 20% return, but maybe there's a 90% of it's on a mortgage or something like that, which a bank would be pretty slow to do it. But let's just say, they figure out a way to, the bank gives them this, and then they've got other private loans coming underneath to make it. That's the kind of thing where to goose up that return, you just gotta be careful of that. And it might be okay where they're like, they've got good reasons and they've done the math behind it and it's fine.
All right.
That's particularly important for longer term holds. You want to make sure that's the case. If it's a flip, 90% of the time it's 100%
So what was the red flag in like normal person terms?
Oh, the red flag is if that loan to value number is, say, like higher than 80%, you just want to ask a lot of questions about the business model and just really make sure that there's enough cash flow to make it. Because in Oregon right now is flipped, so that doesn't work right now. But in other places, if that's just one way that's a dial that they can turn.
Okay.
It's like, we're going to get this thing to be huge.
That makes sense.
Yeah. A big red flag, a newbie. Someone who's never done it before and isn't partnering with someone who has done it before.
Ooh. All right. Yeah. I could see that as a red flag.
Yeah. Just knowing our first round, right?
Right. Yeah. We made some mistakes. And
that's actually interesting. I would say for every single deal that I've done, especially last year, there was always something, there was some new element of every single deal. Right. I'm like, oh, I didn't know that. And just like slowly working through it. Like the one that we talked about a couple weeks ago was, the one that we're splitting a lot. There's a lot there in terms of like, okay, the steps that you actually have to take to do it, to make it happen. I mean, we're taking the steps and we're doing it right. But it was actually funny. We had this whole round robin set of phone calls at one point where we were like, wait, is this going to work? Are we allowed to do this? Is this a thing? And like after an hour of calling, it felt like it was like 8 people. Like it came back around to like, oh no, that very initial meeting that we had was the right meeting. It's the right thing. It's the right step. But they just didn't, the way it was mentioned in the meeting, it got super confusing. And because the mobile home is technically personal property, it's not a home.
Oh, yeah.
Right? Because that place is zoned in such a place where you only allowed to have one home and there's already a home on there. So it's personal property. And we were like, well, yeah, but we want to like, we're going to split the lot. And then the question was, and because it's personal property, in theory, once that person moves, the home has to go away because it's not a home, it's personal property. And super strange. We're fine. We got an exception because they know we're going to split the lot. And then once we do that, now we have a new lot that doesn't have a home on it. So we can put one on it. And so this personal property can now turn into real property.
Weird.
It's super weird. It's something I've never done before.
Right.
But that's the only element of it. Everything else I've done. And so that's like, I'm okay with stepping out on a ledge for this one thing. And like I said, it turns out we were doing the right thing. The very first meeting we had to split the lot, it turns out like, that's just an automatic thing that happens in the process. And when I finally looped back with them, they were like, oh yeah, no, you're good. Like this will turn into real property.
So
I was getting all nervous.
So basically you're just saying that someone might have a red flag if they realize this is the first time you've done this type of deal.
Potentially. Yeah.
However,
like if you've had someone who's like, oh yeah, I bought a bunch of single family homes and now I'm doing this 200 unit apartment building.
Okay.
Like, all right.
That might be like
of different color.
Different.
I mean, think about this. Our storage facility that we bought, it was bought by a bunch of house flippers.
Yeah.
And they flipped the house that was on the property and it looked awesome, but they had zero experience actually running the facility and they were running it into the ground. So we got a great deal. Yeah. But they had never done that before.
Okay.
So it was a bad deal, which is why we scooped in and I was like, yeah, we can come in and add some systems and operations and make this thing great.
So you as a sponsor, like you like to do new and different and interesting things.
It's true.
So how do you mitigate?
Yeah, for me, I try to only have like one new weird thing each time.
All right.
That's like I said, the splitting of the lot. I've bought homes. I've flipped homes. I know what I'm doing there. I know that entire process. Like with the storage facility, I had already owned an apartment building. I had run it. I had revamped it. We had taken it from moving everybody out, fixing it up, and totally refilling it. So with this one, it was like, okay, I know how to refill it. Yeah. The only difference is the marketing plan is a little bit different now, but the rest of the process is the same.
All right.
And sometimes it's a different location, right? Like the warehouses, right? That was one where it's like, yeah, I've rented out places. Now it's to business customers. The leases are different, but the fundamental thing is the same.
That's a good answer. And as an investor, you should be aware of those red flags and ask about it.
Yeah, exactly. Yeah. And there's things that you can do if they don't seem like, again, if they're brand new, like that's pretty obvious. But you can ask questions about the market or just their track record. What have they done? What have they learned? And they should like lay out like, yeah, here are the risks that I see. Yeah. Because they thought of it. Okay. We kind of alluded to this one earlier, but essentially like some red flags would be just like vague plans. Like not really saying here's the exit plan. Yeah.
That would totally be a red flag to me. If I'm looking through things and I come up with more questions than answers, that would be like, you okay? Like help me out here. Yeah. You know, if I'm asking these questions, you definitely should be asking.
Well, there's very difference between saying like, we're going to sell this place, but if we can't reach the number that we want, we will then rent it until it grows to the point that we have versus saying, well, we might sell it, we might rent it. We'll see.
Knows?
Right? It depends.
Yeah.
You should always follow up on, it depends on what? Yeah. Same thing with the construction plan, right? Where they're like, so we're going to fix it up. Cool.
Yeah. Great. Give me some parameters here.
Yeah. How much? How do you know these are the things to fix?
Mm-hmm.
You know, those kind of things.
Makes sense.
Yeah. Or if there's like, it's a strong market. Like, dude, what was it? It's in The Martian, right? Where they're like saying, you'll be the fastest man alive. And he goes, fast is not a word that, what does he say, scientists or physicists use.
Yeah.
He goes, to describe speed. They're only saying that because they think I won't notice, and I think it sounds cool. I do think it sounds cool.
But that's not the point.
Yeah. So you want to watch out for those kind of like superlative, qualitative types of comments on things that are kind of inherently quantitative.
That makes sense.
Yeah. There's some other things where, I don't know, like it doesn't seem like they're planning for things. Like they don't have a reserve fund.
Ooh, yeah.
For example, like for us, every single deal, we set aside 10% to do it in addition to just being all the conservativeness that we have.
Yeah.
That's a big one. Or very aggressive ARVs. So like we actually had a recent same property, this one on Thornton Avenue, where we went in and said, okay, here's what we think the value is going to be when it's all done. And then part of the lending is we got what was called a BPO, which is a broker broker price opinion. Boom!
Oh, wow.
Pulled that out. Essentially, someone else who doesn't care, is third party, comes in and says, this is what I think the value is. And they gave a report, and thankfully our number was less than their number. So they were like, no, I think this is worth more than you thought. We're like, yes. So that's good. So, but like, you could have the opposite of that, and you just got to watch out for that kind of stuff. Right. That's kind of, honestly, that's my move. I get conservative a little bit everywhere, which makes it really conservative by the end. Yeah. And so not always, but it's a classic under promise, over deliver type of thing. And that works for me. Yeah. And it makes it so I honestly can be like, well, I don't have to be perfectly exact on everything, because as long as I always bias myself down, I'm okay.
Well, and as an investor, you've got to evaluate that for yourself as well. You know, what am I comfortable with? How conservative, how much buffer do I need in a plan to be able to be like, yeah, I'm good with this. I think, I trust it. Let's go.
Yeah. Yeah. I think another round of risks has to do with like investor protections. Like, for example, so a waterfall is what they call how things get paid out. Okay. You don't know which people get paid. Sometimes a sponsor will set it up where like they get paid first, and then only if there's leftovers, everyone else gets paid. I'm like, that's not great. You should be opposite. That's what ours is. Our investors always get paid first, and then I get whatever's left over. Yep. And or they're just not transparent about it, and just kind of like,
you'll get paid.
Well, I'll get paid.
Some point.
Great. That's a problem.
Yeah.
This one's kind of an interesting one. No skin in the game.
Oh, yeah.
Yeah. So you want them putting some in. This is probably the place, if I'm just being honest, that I'm the weakest at. Oh. I don't tend to put a lot of skin in the game because we've got it in other places. I think for things like flips, it's less important versus, say, like a longer term thing, because the longer ones, with like flips, it's like, we got a game plan, we're working the game plan, here goes the game plan. It's short. Whereas like longer term ones, you really want to make sure incentives are aligned, and if that other person's invested, they're aligned. I tend to at least do whatever the earnest money down is. But yeah, flips are a little weird too, because you're raising way more than you need, because you're doing repairs and everything too. But yeah, and that's probably something over time that I will be working on adjusting.
And when you say skin in the game, you just mean like your sponsor well, yes, I mean money, but I know money, but you mean as the sponsor, like your company is funding some of the deal.
Yes, correct.
You're not talking about like you personally are also part of this investment.
Yeah,
I mean, you are, but
okay. Yeah. I think, and for me, honestly, like a big piece for me is reputation too, right? Put my name on it. That's a big deal, to me, because I can only mess up once.
Yeah.
So that's a big part of the skin that I have in the game. Saying like, yeah, no, I'm out here, I'm talking about it, and that's a big thing. You know, in some ways, it's making public commitments. We're gonna flip this thing. It's gonna be awesome. Investors are gonna make money. Yeah. Yeah. Let's see here. There might be some like market red flags that you got to look out for. Just like weak market fundamentals. You know, like this is probably one of the things that Oregon struggles with. Like I said, cap rates are really low right now, which means prices, especially for multifamilies, are high relative to the cash flow that they provide.
Okay.
And so that's a red flag for any investment. And so trying to say like, yeah, we're going to have something like, so if you know, which, because you listen to things like this, you now know about Oregon's market. If you get offered a deal where they go, hey, the cash on cash, the monthly cash flow is going to be awesome. You go, really? How is that going to happen? Like, tell me more, because that's not normal. There might be some regulatory things, right? Like, for example, again, in Oregon, for the longer term hold stuff, we've got rent controls. So you can't just say, we're going to go and improve everything and make it awesome. Now, what's cool about a property that I'm refinancing right now, it's a student housing, and it's new leases every single year, which is awesome because it means every single year, boom, we get the reset, which is what we did when we first bought it. And we didn't have to wait and do the slow incremental stuff, which is really nice. But that's not the case for a lot of multifamilies. And so that's one of those, like, it's not necessarily a red flag, but you want to pay attention to how fast they're saying they're going to ramp this thing. Because if they're like, honestly, anything, it depends on how low it is, I guess. But you just got to,
the red flag would be if the sponsor's making promises that you know they couldn't keep.
Yeah.
That's like,
Another one that's not necessarily a red flag, but one that is dependent on a certain like business plan. So like I'm thinking like short-term or vacation rentals, right? Again, it's not a red flag, but if what they're doing is that more niche type of thing, again, you just want to make sure they have experience in that area. And it's always worth asking a question, well, if that doesn't work, what do we have?
What's the plan?
There's a guy who I follow online. He does a lot of creative finance stuff. And he always underwrites his things for long-term rentals. Then he goes, but if I can turn it into a vacation rental and make more, sweet. If I can rent it out by the room and make more, sweet. But the deal has to make sense as a long-term rental because that's the lowest return that it'll possibly get. And he goes, yeah, worst case scenario.
That's kind of an interesting.
I place somebody, I walk away, I'm done.
Yeah. That's kind of an interesting way to approach that.
Yeah. It's a smart way to approach it.
Hedging your bets a little bit.
Yeah, exactly. And now he walks in saying, well, I'm going to try to do the highest and best use, but I can always fall back on
there's other options.
Yeah, which I think also helps on negotiation side of things. Because he goes, look, I'd love to pay more, but man, as a long-term rental, this is all I'm getting. Help me out. Yeah, I like that. Okay, execution issues, flags, potentially, timelines. You know, if they're like, we're going to get this thing done in 2 months. No, you're not.
Yeah.
A lot of our projects are in that 6-month range, and honestly, that's an average. In some cases, we actually go over. In some cases, we're way under.
Okay, I have a question here.
Yeah, ask it up.
Okay, this to me sounds like if there's execution red flags, you're already in it sometimes, you've committed, you're moving forward. What would you recommend someone does if they're like, man, I thought everything looked good, but now like they told me 6 months and they haven't done it. They haven't returned anything. They didn't match their timeline.
Yeah.
Their numbers didn't match what they said.
Are they communicating with you?
Yes.
I'm okay with that.
I would say in one scenario, yes. In another scenario, no. That's your tipping point. Is like the red flag is if they stop communicating altogether. Yeah. Something's gone wrong.
Yeah, I think so.
Huh.
Because there's reasons.
Sure.
Yeah. As long as they're communicating and adjusting things.
All right. Well, what would you tell someone if you were in that situation as the sponsor? Like you communicating to them, let's say you miscalculated hugely. Okay. And you're like, dude, okay, you wouldn't call them dude, maybe. Like, investor man, I thought that this project was going to be, $70,000 to do all these repairs, but we found something while we were going through there, and it's actually significantly more.
150,000.
Yeah.
Yeah, you just got to tell them.
The timeline has to shift. You just tell them.
Yep.
Huh. And you don't think that would be a red flag?
Oh, it's a huge red flag.
Oh, it is a huge red flag.
But what are you gonna do? At that point in time, what you need to tell them is, hey, we messed up on the underwriting. The plan isn't gonna work. So we went back to the drawing board. We did these 3 to 5 different scenarios. None of them are good. This one is the least worst. So we're gonna go here. No matter what, we're going to return the money that we promised that we would get you. We'll figure it out, even if it means I have to sell this other place to make it happen.
Interesting.
This didn't work. Here's what I've learned. Here's what I'll do differently next time so this doesn't happen.
That's all you can do.
Yeah.
I mean, how often does that happen that there's like a big surprise like that in a deal?
Depends depends on the experience of the person, you know? I don't know.
I mean, just in the set of deals, like think of all the cumulative deals that you've done. What percentage of those had that wasn't what I thought?
So I think about this one that we did. It's a single family home in Lebanon. It was a total gut start over.
Yeah.
And anytime you do that, you're gonna find
stuff.
You're gonna have exactly.
Yep.
But we padded the budget enough, and we had some nice things that we wanted to do, and we did some shifting. Like there's a bunch of work that we want to do in the garage, and ultimately went, you know what?
Yeah.
I don't think we're gonna do that. We're
just gonna do the basics.
It's the garage.
Yep.
And it's okay.
Yep.
And it was because there was a whole bunch of stuff with like the water and the well that it was on. It was garbage once we really started looking into it.
Yeah.
We're like, this is going to require a whole new thing. And so there were like 4 or 5 of those types of things that happened in the project. But again, we had a 10% buffer on this $100,000 project. So we had 10 grand extra to play with. And some of that stuff was like, okay, we can rob from over here to take care of this because this thing's more important.
Yeah.
That was the closest we got to it. Other projects. One of our strategies is we try not to take things to studs and start all over. We instead focus on like, okay, what do we got to do to get this thing so that someone else can what do we got to do to turn this into a lendable value add property for somebody else?
Yeah.
And that reduces a whole lot of risk on our end because we're not tearing into stuff. We're not trying to redo things.
Yeah.
Instead, we're putting that risk on the homeowner who has a lot more flexibility, a lot more budget to say, well, I'll just take care of this myself. I'm not going to necessarily hire someone to do it.
Yeah. And a lot more time to invest in it. And
And so that's one of the things that we do to mitigate it. But yeah, no, at the end of the day, I think it's not good enough just to say, hey, we messed up. You got to come bearing solutions. Yeah. And it's the classic 1-3-1, right? 1 problem, 3 solutions, 1 recommendation. And so that's the kind of thing that you come to people with. Right. And depending on the structure of the entity, you might even talk to people and say, hey guys, what do we want to do? We can, like, for example, you might say, hey, this project is not what we thought it was. We can cut bait right now, and we're all going to either break even or lose a little bit of money. But we know it. Or if you're all willing to contribute 20% more, we can move forward, and we still think this thing will be profitable 2 years later than what we initially thought. So we thought 5 years, now it's 7 years, but if we can get over this hurdle, we think we'll get there. Or, I don't know, we thought we would double your money, but if you contribute 20% more so we can get over this speed bump, you're not going to double it, but you'll still get 50% or 150%, whatever. And you might put it out to a vote. Hey, what do you guys want to do? And you'll have some people go, dude, I don't have the cash for this. You go, all right, cool. Now we got decisions to make. And maybe you got to readjust the cap table, which is a pain in the butt. But, there's things like that you can do. Yeah.
As an investor, you probably wouldn't get me to do that more than once.
Contribute?
I might contribute with 1 adjustment to the plan.
Yeah.
If you had to come back and do it a second time, I'd be like, nope.
That would be...
We're done.
That would be bad.
Yeah. So
I would try to, asking for, doing a capital call is what that's called.
Okay.
You want to try everything else before you do that one.
Yeah, it makes sense. Because it's like, it kind of indicates that you messed something up and didn't quite...
Pretty big time.
Ask for the right number in the first place.
Sometimes what happens, and this could be super annoying, let's say that you've got a project that you're doing, like you started it 5 years ago when interest rates were nice and low, and you do all this stuff, and part of the exit plan was we're going to refinance this thing, return everybody's money, and then we're just going to hold on to it, enjoy the cash flow, and then in 20 years from now, we'll sell it or something like that. And that's the plan. Well, you go to do that. Well, now, because interest rates are so much higher, turns out you can't, not only can you not refinance out everybody's money, you're actually going to need to bring some money to the table in order to actually refinance this thing. And so now the question, and now that things get tricky, right? You go, okay, so in order for us to refi, everyone needs to bring, I don't know, $5,000. But we, in theory, will still make some cash flow as it goes on. And in the future, we will be able to sell it, and you will make a profit more than whatever. You go, or do we just sell it? And, and say, no one's going to contribute. We're all going to make a whole lot less money though, because the interest rates, because what you might be saying is because interest rates are higher, we're not going to be able to sell it for as much as we wanted to because the next buyer is going to come in and not be able to qualify for as big of a loan. Or we wait this out and we see if interest rates will lower, in which case we will be able to sell it for more because people will be able to pay more.
Right.
Oh, which is like,
could be a long time.
Yeah. No, it could be.
Huh. Interesting.
Yeah. So those are the kind of conversations that you try to have. That's one of the risks with the long one. Actually, right now, like if you can find a bigger deal that's long term in these interest rate environments, like that's amazing because chances of them skyrocketing.
Right.
I'm gonna knock on wood real quick. It's pretty low, and so if they do lower in the future, dude, it's like just a double win.
Yeah.
Yeah, it is indeed. Indeed. Let's see here. We talked about the other stuff. Can I hit them up? Like unclear communication was one of them. Oh, another red flag. This one's a good one to end on. Pressure to invest quickly.
Ooh, yeah, that would rub me the wrong way.
Yeah, I mean, I know for my stuff, I present good deals to a lot of people, and so they fill fast. Which it's like, yeah, you got to act fast, but
but that's not you saying you've got to do this today, otherwise it's leaving your inbox. That's just you saying, here's the deal, and there's multiple people being interested. So that's a little different.
Yeah, no, it's true. Yeah, but that's like, if someone's saying like, are you in or are you out right now? Ocean's 11 style.
It's all that, all those spam calls. Oh my gosh.
Yeah.
I've had so many recently that like they are capital type things. They're like, we've got money on the table for you today, but you have to give us a call back within the next like 12 hours. I'm just like, oh my gosh.
For that, by the way, somehow.
No.
You were associated
somehow
with me.
I got on the list.
And so when I was applying for a loan.
I'm on some document somewhere.
Actually, yours wasn't bad. I think, what was my first day? I think I got 60 phone calls and then I was down to 40.
I know.
Today wasn't bad. I think I only got like 15 or 16.
I'm down to like 2 a day.
Oh yeah, I'm excited for when I finally drop off the list and they decide I'm a cold lead. But I'm not there yet.
block.
It's pretty bad. But yeah. So anyways, those are red flags. I think all of those are important. I think they're good to look at. Yeah. And when you're evaluating deals in that moment, you want to kind of keep those things in line. And there's a whole bunch of them. Again, I've got a whole due diligence checklist. You may not need all of them, but it's worth to read through, keep them top of mind, and maybe even pick out like, these are the things that I care most about. They seem important to me.
I think too, that's what I was going to say is make your own list of red flags that you're like, these are the things, maybe based on yours, but also just from your gut. Like, these are the things that matter to me the most.
Yeah.
And when you're looking at deals, review those. Make sure you're looking out for them.
Yeah, exactly. And if you want to check out mine, you can get it at furlough.com, and you can also learn more about us and our investing philosophy and how things work. And so with that, thank you for listening. If you love this, would love it if you gave it a like or review wherever it is that you listen. And with that, have a great day.